Learn how IUL is the ultimate tool to become your own banker. And they're only crediting you 4.5%. What's the difference? 3%. That's called a spread. That's called an arbitrage. If that goes down in value and my money's not tied up in there, it's over here, I didn't lose. My money's still over here earning a rate of return greater than the net cost of the funds. This is a concept that's very intriguing, but frankly, a lot of people do not understand. My goal is to help you understand so you don't miss the boat. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 50 years, 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. Well, my favorite financial vehicle for many reasons is a properly structured, max-funded, indexed universal life. If it's structured correctly and funded properly, it is deemed what I call a laser fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. And I've authored 12 books, but my most recent best-selling book that's flying off of our warehouse shelves is called The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement. It retails for $20 on Amazon. This isn't about trying to sell you a book. In fact, I'm going to gift you a copy of this, so stay with me to the end. You do not need to buy it on Amazon for $20. If you do, thank you, but I'll gift you one, so stay with me. So let's talk about how IUL, if it's structured correctly, is the ultimate tool if you want to become your own banker. But you need to understand, first of all, how money works. And it's amazing how many people do not understand this. There are basically 4 things you can do with money. You can spend it, you can lend it, you can own with it, or give it away. Now, people say, what do you do, Doug? And I go, well, I sort of double dip. I actually loan and own simultaneously on the same money. That always intrigues them, and they go, please explain. Okay. See, when you put your money in a bank or credit union, or even in an insurance company, it's in a lended position. Are they just a benevolent institution paying you interest? No. You put your money in a bank and they pay you, let's say, 4.5% interest on a CD. They're not putting your money in some vault and magically coming up with 4.5% interest to pay you every year without putting your money to work. So they invest it, they loan it back out again to you at 7.5%. You take out an equity line of credit, they charge you 7.5%. So they're making 7.5%, and they're only crediting you 4.5%. What's the difference? 3%. That's called a spread. That's called an arbitrage. Now, they have overhead. They have to pay for all their employees and their buildings and everything like that. They may only net 1%, and they make trillions doing this. So do insurance companies. And yet there are short-sighted financial advisors that go, you'll do all that for 1%? Yeah, and they make trillions. You can do it safer than the banks do, okay? So how do you do it and become your own banker? Let me make sure I understand the math. Banks, if we went back to 2008, and what happened for the second time in a decade in this great recession from 2000 to 2012, for the second time in a decade, people lost 40% on the value of their IRAs or 401ks invested in the market because the market dropped 40%. It took 4 years until 2012 to make back what they lost. It took 4 years after 2003 to make back what they lost. They had to wait till 2007. Well, in 2008, a lot of Americans do not realize how close we came to a total financial collapse in America. In fact, David Walker, the Comptroller General for the General Accountability Office, resigned because the Obama administration that had just come in refused to let him alert the public on how close we were to a total financial collapse. Well, they asked the 5 major banks in America to disclose where they had their Tier 1 assets for liquidity and safety. And guess where they said they had their money? They were only paying about 1% or less to people who had money in their banks. Let's give them the benefit and say 1%. So on every $1 million of OPM, that's other people's money, they might pay out 10 grand a year in interest, okay? Why would they do that? It's because they were taking 30 to 40% of that and putting it into insurance companies that, frankly, those insurance companies, many of them are rated AA and AAA, whereas a lot of these banks were only rated BBB. How much better is AAA than BBB? It's like 6 notches higher in safety. They were increasing the safety of your money that you put in the bank. They increased the safety by 6 times, and they increased the rate of return by 5 times. Many insurance companies were crediting them on $1 million 5%. How much more is 5 than 1? Don't say 4. It's 500%. It's 5 times. Would you hire an employee for 10 grand that made you an extra 50 grand? Would you buy a widget machine for 10 grand if that widget machine made you an extra 50 grand? That's called a 500% return on employment cost or equipment cost. I'll do that all day long. So that's what the banks were doing. So how can you do that? Well, if you look at how I have used OPM, borrowed money in my lifetime, let's say to acquire real estate, okay? So every $1 million in the last 40 years, I've probably paid on real estate mortgages around 6% average interest, sometimes as high as 12%. But it's been tax deductible. It's a net cost of 8 after tax advantages in a 33% bracket. But if I borrow 6% on $1 million, that's $60,000. I get to write that off if I do it right under Section 163 of the code. And so that's a write-off. In a 33% tax bracket, that saved me 1/3 of $60,000 in actual taxes, 20 grand. That's real money, okay? It's not paper money, it's real money. And so this is where I have a net cost of 4%. And when I say this is real money, not paper money, yeah, money's paper, but this isn't some phantom number on a sheet of paper like a balance sheet. This is real, actual money I'm saving. So the net cost in a 33% bracket of a 6% mortgage is really 4%. Do you understand that? If you don't, you better back up. So I'm paying a net of 4% or $40,000 on every $1 million. Now, if I'm my own banker, I just have to make more than 4%. Where do I do that? I do that with the max funded indexed insurance contract with the same insurance companies the banks are putting your money in. I turn around and I've been making more like 10%. Let's just round it down to 8. I can make 8% tax-free. Compound interest, this is simple interest, but the very first year, if I'm making 8% tax-free, that's $80,000, it costs me $40,000. This is tax-free. This is tax deductible. This is why it's a net cost of 4. How much more is 8 than 4? Don't say 4. 100% more. Would you hire an employee for 40 grand that made you an extra 80 grand? I'll do that all day long. But in actuality, I've been doing way better than this, okay? In fact, in the low interest environment back in 2008, when banks were making 500%, interest rates are relative, okay? So on every $1 million, when interest rates are low for borrowing, they're low for earning. When interest rates are high for borrowing, they're high for earning. Clear back in 1980, I was borrowing money at 12% on my real estate in a 33% bracket, a net cost of 8, and I was making 15% on my universal life. Well, in 2008, I was borrowing money at 3% with my credit, and that's $30,000 on every $1 million. Tax deductible in a 33% bracket, that's a net cost of 2. It really only cost me 20 grand on every $1 million. And guess what I was making? I was making 11.17 and netting 10.07. Let's just round it down to 10. I was making 10% on that $1 million in my IUL. That's 100 grand. Would you hire an employee for 20 grand that made you an extra 100 grand? That is a 500% return on employment cost. The banks were making 500%. I was making 500%. We were both happy. Were you making 500%? If you weren't, you better learn or you're missing out. Okay. So let's go back to the key elements of a prudent investment. The key elements of prudent investments are, number one, liquidity. I do this so that my money stays liquid in a laser fund, okay? The ability to access your money when you need it. If I were to pay a huge down payment or send extra principal payments to the mortgage company, I'm giving up liquidity. And that can get you into trouble. I learned that the hard way. Number two, a key element is safety. Safety of the institution, but also safety of principal, okay? Because that real estate, if it goes down in value and you have your money tied up in the property, you will lose, I guarantee you. If that goes down in value and my money's not tied up in there, it's over here, I didn't lose. My money's still over here earning a rate of return greater than the net cost of the funds, okay? What about rate of return? I'm able to continue to earn a rate of return tax-free here, even if I have to pay interest on this over here, because the interest I'm paying over here is half or only 1/5 of what I'm earning. Are you starting to get it? Okay. So let me give you some examples. People will say, Doug, you didn't pay an extra $100,000 in a down payment when you bought this piece of property. You had the money. Why didn't you do that? That would save you paying interest. I'm going, no, that would cost me money. See, banks and credit unions and insurance companies, they don't view paying interest as their foe. If they stopped paying interest, they would wither up and die. A bank or credit union's greatest assets are their liabilities. Did you hear that? If they stopped paying interest, they would stop making money. They would wither up and die. So for every 100,000 of money that I did not put into an unnecessary down payment or paying extra principal payments, that I kept separated over here in a laser fund, compounding tax-free, people say, well, what if you were paying 9% interest on that mortgage and you were only earning 7.5% over here? I'd still do it. Why? You're not going to get anywhere. You're not getting it. If I borrow at 9% tax deductible interest in a 33% bracket, that's a net cost of 6. I'm making 7.5. And they go, you'll do all that for a 1.5 point spread? Yep. Why? If I only do it at one time, a one-off, on $100,000, that's an extra $750,000 over 30 years. Math doesn't lie. That's a one-off. That's with a 1.5 point spread, okay? And so people would go, well, golly, okay, you kept 150,000 separated. You borrowed at 7.5%, and what if you only earn 6? You're not going to get anywhere. I don't know, 7.5 tax deductible is a net cost of 5. You'll do all that for 1%? The banks do, and they make trillions. I'll still make $750,000 over a 30-year period one time. Just one time on 150,000. Well, I've been doing way better than that. So on every 100,000 of money that I keep separated from tying it up in that asset, because the real estate's going to go up or down in value regardless of whether it's mortgaged to the hilt or free and clear, whether I have a ton of equity or no equity in it, because I keep it over here. Liquid, safe, earning a rate of return greater than the cost of the funds. On the surface, I've had critics, Dave Ramsey's one of them, when people call in and say, well, Doug Andrew, he might borrow at 6.5% and he earns 8.5% for a 2-point spread, and he'll go, you'll do all that for 2%? And I'm going, yep. Hello? Banks do it for 1% and they make trillions. It's not just 2%. 6.5% tax deductible interest is way less than that. And I'm earning 8.5% compounding tax-free on 100,000 one time over a 30-year period makes me an extra $1 million. That means if you separated 400,000, it's 4 million. But that's a one-off. If you separated 100,000 of equity one time, but then every 5 years as your real estate goes up in value, you continue to separate it. If it appreciated only 5% a year, that will go up to 2.3 million. If you have 400,000 and you did it by repeating the process, that's the difference between arrivers who arrive at financial independence and the thrivers. They repeat the process. You're talking about just under 10 million extra dollars. Other than that, I don't have any strong feelings on this subject, okay? This is math, and it doesn't lie. Now, how does this translate into money in a laser fund? Well, you want to use the same banking concept with your money in a laser fund. So get ready. Laser banking. Many savvy business owners will set up a max-funded IUL as a working capital account for their business, just like real estate investors do. So that means that if I have $1 million of cash value in my IUL policy and I need to use it for whatever, I can go withdraw $1 million, but it's no longer there earning interest. So I go borrow $1 million, and people go, why would you borrow your own money? Well, I'm technically not doing that. I'm borrowing from the insurance company $1 million, and it is a no-brainer loan because you don't have to qualify because you have $1 million sitting there. If you had $1 million sitting in a bank, they're going to loan you $1 million if they can keep your $1 million in the bank as collateral. The insurance company is saying, okay, your $1 million is here with us, so we'll loan you $1 million. Now, they can, give you a loan, a zero net cost loan or a zero wash loan, meaning I can borrow $1 million and they'll charge me 2% interest, and then they'll credit me 2% on the $1 million of cash value that I left there as collateral. So they charge me 2, they credit me 2, that's a zero cost. Well, if I understand how money works, and most of my business owning clients do, they go, oh no, I want the insurance company to keep crediting me 5, 10, 25% on my IUL cash value, not just the 2% you're charging me. So the insurance company goes, well, we have to charge you a little bit higher interest. That's okay. So that's called an index loan, and they might charge you 4 or 5%. Well, let's say 5%. 5% on $1 million. If I go borrow $1 million from the insurance company, using my $1 million as collateral, that $1 million that I left in my policy as collateral, it's been earning an average of over 10%. How much more is 10 than 5? Don't say 5, it's 100% more. I'm making 50 grand tax-free on my money while I'm using it for whatever I'm using it for to make more money. But let me show you something that's going to blow you away. I have a business owning client who understands, yeah, you could make 500%, because if you borrow at 5 and earn 25, which he did in the year 2017, he was making 500%, just like I was. In 2017, he called me up and he said, Doug, I have this strip mall that I want to buy, and I need $1 million out of my IUL policy for the earnest money. I mean, it's like 17, 18 million. I need $1 million of earnest money. I said, how soon do you need it? And he says, in the next week or so. So he said, send me the form. It's a 1-page form. He puts his name and his policy number at the top. And it says, would you like to withdraw $1 million? Check here. Or would you like to borrow $1 million? Check here. Where do you think he checks? Borrow. And then it says, do you want the zero cost loan or do you want an index loan? He goes, indexed. That year, he borrowed $1 million out of his policy, okay? Or borrowed $1 million from the insurance company and left the $1 million in the policy is technically what's taking place. And he borrowed at 5%. That's 50 grand. He didn't have to write out a check for 50 grand because they automatically deduct that from what he has in his policy, the $1 million. Well, that $1 million, what did it do that year? It capped out at 25%. He ended up with $1,250,000 at the end of the day. On that $250,000 minus the 50, he netted $200,000. He ended up at the end of the year with $1,200,000 tax-free. He netted 20% that year on his money tax-free while he was technically using that money to make $3 million buying, fixing up, and flipping a strip mall. Are you getting it? This is how to become your own banker. So hopefully you've gained some insights into opportunities that you never knew existed before. If you want to learn more, stories like this and many others are in my book, The Laser Fund. You can go to Amazon and pay $20 for this. And if you do, thank you, but I'll give you a copy free. So to claim your free copy of this 300-page book, now it's actually 2 books in one. This white covered side is the left brain side, 200 pages, 14 chapters with all kinds of charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. 1 chapter devoted to basically what I've been talking about here. And so if you want to use your whole brain, you can read both of these books. But simply click on the link below or go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that and I'll pay for the book. Now, I will fire out a hard copy to you via priority mail, but when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's options for that, for those formats. There's also educational webinars we teach on a regular basis. They're free, but you can schedule an appointment with a certified IUL professional that I oversee that for no cost, no obligation, can show you how a properly structured max-funded IUL can work in your particular set of circumstances, because I assure you, you want to make sure it's done right so that you don't miss out. I've seen too many of them designed wrong, and you are not able to earn rates of return like I've been talking about here. And so I have a lot of people say, I've never seen an IUL do this. Well, then you've seen ones that have been designed from 99% of IUL agents out there who are not certified professionals to understand how to do this right. And it's too good of an instrument to not have it done right for you. So make sure you talk to a certified IUL professional.